Welcome to the Game of Finance. I'm here today with Nick from Hitch Advisory. Nick, welcome.
Thanks for having me, Matt. It's a pleasure.
Thank you, mate. Today, I really wanted to, understand a bit more about your story and how you've built Hitch to where it is today, and also cover some property and finance related content that will really sit with our business owners and property investors. But first, mate, please tell me about Hitch Advisory and how you got it to where it is today.
Yeah, thank you. Well, it's an interesting story because it was either start a law firm or drive Uber, and that was 2015. And I just got to a point where I was working in a pretty large law firm. I felt a little bit disgruntled with the lack of sort of reward for effort, and I thought, well, there's got to be another path through this. And so I sort of had, back then I was primarily just doing private treaty mergers and acquisitions. So it was all about buying and selling businesses. So I literally started in the October of 2015, and pretty much that's all I did for 12 months. And then quickly it snowballed because people found that we were a little bit more progressive. Our advice was far more commercial, far more sort of conclusive advice, which meant that we could then build out a property function, litigation and insolvency function, and then more recently a wills and estates function. Today we're pretty much a full service law firm.
Fantastic, mate. And how many people do you have with you now?
So we've got about 33 in total, 5 of which are in Adelaide. So we opened in Adelaide in July 2024, and we're about to open in Melbourne this month.
Fantastic, mate. Very good. And in terms of the type of transactions you see yourself doing as a firm, it sounds like you've got many specialties, but in terms of the ones you see as your core specialties, what are they?
Yeah, so I think our core specialties are sort of private treaty mergers and acquisitions in excess of maybe $10 million. Anything from 10 to $500 million is where we have a real skill set. I think our team are very commercial, very practical, and ultimately they want to make the deal succeed. So that's on the business side. But then on the property side, we're doing anything from land subdivisions in regional and rural areas all the way to substantial shopping centre acquisitions. So it's probably mergers and acquisitions on one side and then property transactions on the other side.
Fantastic. And I guess with property, obviously we come across many and getting the right advice is always key to make sure those transactions go smoothly. When it comes time to buying a property, I guess, when do you see the right time is for an individual to engage their solicitor as well as their team of advisors when they're looking to make a property acquisition?
Yeah, so I think we sort of see people fall into a couple of kind of categories when it comes to buying a property. You've got your principal place of residence purchaser, and often they won't have an accountant, they won't have a lawyer, they may have connections with someone like yourself in finance, but often those transactions move quite quickly because of the price of the property. They're often heavily contested, particularly in places like Sydney. So they will move really drastically, and often their legal relationship is just by chance. Somebody knows somebody, or they jump on Google and find a local conveyancer. So they're one category, the first time home buyer. And then you kind of get a little bit more sophisticated where they might be buying, one or a couple of investment properties, either in a super fund or just in their own names. Typically, we'll see that they probably already have a legal relationship with someone like us. They probably already have an accounting relationship by that stage, and they almost certainly by that stage are probably going to be working with someone with your expertise. And then at the more sophisticated level, we see the sophisticated property investor and or property developer, and they're the easiest to deal with, if I'm honest, because they usually have a pretty switched on team of advisors around them.
It's interesting, I have the same experience. So we find the higher up the deal curve you go, generally more buy ready they are because they've got that team in place to be able to get the advice pretty quickly. And I think that's probably a learning that a lot of, I guess, new or property investors that are going up the deal curve in terms of asset size or number of properties should really look to take on board. It's having that team and ensuring that are all on the same journey with where you want to go as an investor to ensure that you can get the right advice at the right time.
I totally agree, and I think a lot of people, particularly in the early stages of buying a property and or investing, they're a little bit scared of the costs when it's actually, to get the right structure in place, is not actually that cost prohibitive, and it just means that if a property does come up either through a buyer's agent or on your realestate.com or Real Commercial or whatever they're using, they can just pounce on it. You know, they've got their structure, they can call you, you can make the application in the right entity, and you know, their accountant is already aware about what you know, their legal team and their finance team are doing.
Yeah, it's interesting. I think the structure is one that's probably got a lot of airtime recently from a finance perspective around how to structure things and why, and how it's going to benefit your lending, how it's going to benefit potentially, you know, your legal position as well, and your taxes. And I want to dive into that in a little bit. But in terms of, I guess, when you're getting to the stage of reviewing contracts and needing to engage somebody to get that structuring and that contractual advice, a lot of people, I guess, sometimes are confused around a conveyancer versus a solicitor.
Yes.
You know, for yourself, you know, what do you see as the difference between a conveyancer and a solicitor, and how can one or the other work in with giving that individual the right advice?
Yeah, perfect. That's a really good question. And to be honest, a conveyancer is somebody who does have a qualification in the conveyancing of property. They are very well versed, usually very well versed in what they do. But the difference is a solicitor or a lawyer actually has a law degree to back it. And I guess if you were telling me, well, my client's buying a single apartment or a single dwelling, is it okay for them to use a conveyancer? Then the answer is absolutely yes. But where, you know, even the conveyancers that we employ in our law practice, they're overseen by qualified lawyers. So if something goes wrong, you know, particularly if someone's buying a residential property off the plan, or alternatively if somebody's buying a commercial property with a commercial lease attached to it, when problems arise in property acquisitions, people with a law degree, a lawyer, are going to be well versed to kind of assist and work through those challenges and to assert the position of the client better.
Perfect. And I think, you know, from your experience, is there certain red flags or things that individuals from a residential standpoint need to look at versus a commercial contract? Because I can imagine that a residential contract is probably going to be a lot more simpler than what a residential contract or a lease contract may be for the commercial investor.
100%, and I think that's the point, that, you know, you use a lawyer if you're buying sort of far more expensive resi property, or you're buying commercial property. It goes without saying. But in terms of the red flags to look for in the different types of property acquisitions, I think probably the most heavily contested area of property acquisitions, in my opinion, is off the plan stuff. If your client is buying something that is partially complete or not yet started, then you really, really need to have an understanding around when the deposit will be released to the property developer, the standard of finishes that can be expected, and what kind of variations might be allowable under the contract to those standard finishes, and then also any kind of sunset date where the purchaser is required to complete within a certain period of time after the plan of subdivision is lodged. So they're the key points in a resi contract. Little bit different to a commercial property. Commercial properties often have a lease attached to them, and often when somebody's buying tenanted commercial property, the value that they're attributing to that commercial property is based on the yield, and the yield is obviously underwritten by the commercial lease. Now, it's one thing to say, okay, well, the yield is 8% and the rent is this much, and therefore we can imply the value of the property. That's easy arithmetic. But to say, well, how good is that lease? Is that commercial lease something that's solid and bankable? That's a very different story, and it's only really when you send it to your lawyer for a couple of hours to review it and see how the lease looks that you can actually get an understanding of what the property is truly worth to you.
That's absolutely right. And I think what's interesting is when we're looking at commercial valuations, you know, they're taking the lease and the numbers at face value. You know, they're not looking to give you advice on how actually valid, you know, that lease may be under pressure.
Yes.
And I think that's where getting the right advice from the right individuals for the right transaction is going to be so key. Yep. But coming back to the resi side of things, it's interesting. We had an example recently where the sunset clause was looked to be triggered by the developer. And the reason that they wanted to trigger it, to our clients' view, was that the asset had increased in value by about 30% since they bought that property off the plan. So it's one of those things where when it comes to timing and the sunset clause dates, you want to ensure that there's enough time, or you're at least getting the right advice up front to be able to put the right safeguards in place. Because with this individual, he did have to go through a legal battle. He spent about $20,000, but he was going to potentially lose out on $500,000 of asset upside. And this was an owner-occ property they were buying. They were downsizing, so that money was real if they were to lose that property. Now, fortunately, they didn't lose that property. They were able to negotiate with the developer and negotiate a new price for them to purchase that property. But you're absolutely right. You want to make sure that you're getting the right advice, because if you don't, it could cost you the whole property.
100%, and particularly where debt's involved, because if somebody's transacting with their own money, generally they can solve it pretty quickly. But if you're dealing with pre-approvals that may have lapsed, or there might be something else that's causing the delay in funding, that can be the difference between missing out on the property or not. And as you say, sometimes there's value uplift attributed to that as well in the period between signing the contract and the project being completed. Maybe a useful thing for me to touch on is some of the key things in a commercial lease that investors should be looking out for when they review it. So obviously, as we sort of said, the main recipe in a commercial lease is the rent and the tenure. So how long is the term and how much is the tenant paying each year? But then if you look at a list of maybe a dozen other things that people should be looking for, probably the next most important one is the rental increases. And, we see a mixture of things from fixed increases to CPI increases. And those increases, obviously, in recent times, landlords have obviously favoured CPI because it's been running hot. But what landlords don't like, or property investors don't like to see, is when the increase is potentially capped. So if it's an uncapped increase, that's obviously very good for the investor. But one of the things we really see property investors let themselves down on in commercial leases is the security package. So has the tenant provided personal guarantees? Has the tenant provided a substantial 3, 4, 5, 6 month bank guarantee? That means that if the tenant defaults, that the landlord has some sort of recourse until they've managed to find a new tenant for their property. So the security pack's really important.
Now, I was going to say, just on the bank guarantee portion, sorry to cut you off, but we're also finding that there's alternate options for bank guarantees now as well. It doesn't have to be cash in the trust account. It doesn't need to be a bank guarantee by way of a term deposit or residential security at a bank. There's also new type of bank guarantees, or e-guarantees, where if your potential tenant wants to utilize those, there needs to be a provision for those in the lease. And I guess by you being flexible around that and potentially unlocking hundreds of thousands of dollars for your tenant, you could negotiate another aspect of the lease to your favor, whether it's market reviews, CPI reviews, however that may be. So that's just one thing that I see is, quite new and quite interesting. But is there anything else that you're seeing that you think needs to be called out as, something that, people should be aware of?
Yeah, if I can just finish on that point about the e-guarantees just for a minute, because we are seeing them as well. And effectively, they've been used in the UK for a long time. But effectively what they are insurance bonds, where effectively a policy is written in favour of the landlord that has the same effect as a bank guarantee. And often these insurers are Lloyd's of London backed, AAA credit rating, and so the bankability of these bonds or these guarantees in world standard is very good. Obviously in Australia, we see that landlords are a little bit more conservative. Many of them are less willing to take up the guarantee bond or the insurance bond, but we are definitely seeing more of it. And so the providers of those bonds out here are providing some standard wording that can go into the leases, and it's pretty straightforward. And to your point, what could that mean for a landlord practically? Well, a landlord who was basically looking to lease their premises and the tenant was pushing for a substantial fit-out incentive, one way to kind of achieve a win-win outcome would be for the landlord to say, hey, don't pay me a bank guarantee, use an e-guarantee or an insurance bond, and use the money you would have otherwise locked up in a term deposit to do your own fit-out. So that's...
Which could be hundreds of thousands of dollars.
Easily, and it could go a long way to paying for some or all of the fit-out. So I think that's a really, really, really good point.
Well, one question on, I guess, market reviews of leases. We're seeing a lot of clients at the moment, looking for properties that are under rented or under market value versus where the market currently is. And they're looking for properties that may have 2-3 years left to run, and they can look to manufacture that upside by increasing that rental, by way of a market review. Can you walk us through what a market review looks like for a commercial property lease?
Yeah, absolutely. So say you've got a lease that might have an initial term of 5 years and then 2 further option terms of 5 + 5. So in effect, the tenant has the option to run that lease out for 15 years. The landlord's bankability is really only on the first 5. But what a lease will often say, whether at extension of the option or sometimes just during the ordinary term, the lease will say that effectively the rent goes off to an independent valuer for assessment. And once the independent valuer assesses it based on its use and current market rents, then they will say whether the rent is actually accurate, too low or too high. Now, what we, as I sort of alluded to before, sometimes we see that those market review clauses have what we call a ratchet in them, which means that they can't go backwards, but they can go upwards to an uncapped amount. Sometimes we see what's called a cap and collar, where they can't go backwards by more than a certain percentage and can't go up by more than a certain percentage. But I think that is definitely a place for potential commercial property investors to unlock value, is by identifying a property that may have a market review coming up in a year or two, and perhaps it's the rent is too low. One thing I would say on that is quality of tenant is absolutely key. So in the more recent economic climate, whilst perhaps property developers and property investors haven't been as heavily impacted, trading businesses have copped a massive hit, and we can see that just purely by the number of corporate insolvencies that have gone through the roof compared to what they were in COVID and post-COVID times. And so if you've got a tenant who is a retailer or an operator of some kind of business, you really need to be looking at how bankable they are and how, whether they're an ASX listed tenant or whether they have multiple locations across the country. You want to be looking at their commercial profile as a tenant. Are they growing? Are they contracting? Is that underlying business actually profitable and successful? Because if you bought a property that was leased to a particular retailer and you knew from some basic commercial due diligence that the shop was fundamentally empty and running at a loss, you really need to question how long the tenant is actually going to put up with that and stay there. And we've seen a lot of retailers and other businesses just walk away from commercial premises in the last couple of years and leave their bank guarantee behind.
I think that's a great call out. Sometimes the numbers aren't always the driver of a good deal. You want to dig a little deeper and understand that tenant mix, that tenant profile. Even if the potential lease is under market and there's a way to manufacture the upside, how long is that tenant going to be there? Are they in an industry that's going to be here in 5-10 years, depending on what the lease you're looking to provide them is, what the weighted average is across the portfolio or the shopping center or whatever type of asset it is. So I think that's a great call. You want to look beyond just the cap rate, the yields, and what the market review may be, and actually really understand your tenant to ensure they're going to be there for the long term if you're putting such a large amount of money into that asset.
Agreed, and that equally applies whether the rent's too low, because the increase might wipe them out, or if the rent's too high, they might be hurting and nobody really knows about it.
Absolutely.
So ultimately, your lease, the piece of paper, is only of value if the tenant can afford to keep paying.
Absolutely. And just to jump back to the residential part for a second. So
Yes.
In terms of the other clauses that we should be looking out for, I know there's a lot of individuals who are selling who may be asked to release their deposit. We've seen a couple this week already for clients. Could you shed some light on around what the risks are for the vendor if you're looking to release your deposit, and how that could potentially benefit negotiations for people buying, selling property?
Yeah, so obviously a deposit is put forward when residential property is purchased. Commonly 5%, can be less, can be more, but in a property that's being bought off the plan or from a property developer, usually what the developer will want to do is roll those deposits into funding some of the project. Even in an ordinary conveyance where the property is an established dwelling and is being purchased from an ordinary, mum and dad vendor, the mum and dad vendor might want to roll the deposit they're getting from you or your client into their own next deposit. So we definitely see a lot of contracts that have either a partial or a full release of the deposit requested up front.
And what's the risk there if you do choose to release that deposit? Is there a risk that that money could be forfeited if the sale falls over? I guess what kind of safety metrics are built into those contracts for those vendors and purchasers?
Yeah, absolutely there is. There's a risk that money could be misspent by the property developer in an off-the-plan instance, and therefore the project never gets complete, or alternatively, the property developer in that instance goes into liquidation and our client is left as an unsecured creditor because there's no recourse. Less risky in an established dwelling or apartment because typically what we'll first do is put a purchaser's caveat over the property, and effectively what we can do is if very limited number of circumstances where the vendor can actually say, well, I refuse to complete the contract, and particularly with a purchaser's caveat on title, there is typically a way for us to effectively force the transaction to complete. So we can solve it more readily for established dwellings, much more riskier in an off-the-plan scenario.
Okay, interesting. In terms of, I guess, structuring, once you've found a property, you like, you should have done some homework to understand how much you can borrow. You should have engaged your solicitor and your accountant to make sure that you're aligning the legal and both the accounting or tax outcomes of the purchase. But when it comes to structuring, a lot of airplay has been given to using trusts or companies to obtain finance, because if that entity can service itself, or be ring fenced in a sense of income is covering expenditure, we can have that excluded from future assessments. Now, what are the benefits from a legal standpoint of using a company or a trust versus doing it in your individual name?
Yeah, so from our perspective as lawyers, it really is about isolation of asset from risk. And so as a general rule of thumb, once the first principal place of residence has been bought by one spouse in a couple or an individual name, then really there's no need to buy more properties in individual names. Some people have a different view in the sense that they're chasing a negative gearing outcome, but I think what we're seeing more and more of is a trend towards people pursuing positively geared properties. I think you would say that unless somebody through their financial and accounting advice is particularly pursuing negative gearing, then it would be advisable that any investment properties are purchased in an entity. Now, you say, okay, well, for those listening that say, well, what kind of entity? It can either be a trust structure. Now, that can either be what we call a discretionary family trust, or it can be a unit trust, which allows multiple parties to invest in the property. Or what we're seeing more and more commonly is people buying property in a just a corporate entity, and that's no different to a company that's used for any other purpose to run a business or anything else of that nature. And really, any one of those three structures, or even an SMSF to some extent, they will achieve the lawyer's wish, which is to isolate the asset away from the individual risk.
And I think it's interesting you say that, because I think this is where sometimes clients may be led by one advisor more so than another. And it will get to a point where most often from a finance perspective, we hit the serviceability wall. Because what I find is, while a negative gearing benefit is fantastic to be able to minimize your taxable income, if your end goal is to amass as many assets as you can to enjoy the benefits of compound growth over time, and you're happy to forego some of those tax benefits for ultimately a larger capital growth rate over time, if you've got a bigger asset base, then potentially foregoing that capital, or that negatively geared benefit in the short term will help you build a bigger portfolio over the long term and potentially get a better capital gain outcome. And I think the learning that I've probably seen from the clients that we look after is, you want to make sure your whole team is on the journey for where you want to go. And if you ask isolated questions, you're going to get an isolated answer from one of your advisors, and they're looking after your best interest, but they're looking after their best interest through the hat that they wear. And I think that it's really important that if you have a really clear goal from what you want to get from your business and from your property investing and from any other venture, is that you take people along that journey and you take the advice from your accountant, your solicitor, and from your finance broker to be able to get a well-rounded plan to progress. Do you find similar with the clients that you work with?
100%. I mean, and not every client will be prepared to go to this level of effort. But if you could have a whiteboard session with, the accountant who talks about income tax and capital gains tax, the lawyer who talks about isolation of asset from risk, and the finance broker or financial planner who talks about source of funds and source of debt, or source of capital and source of debt. It's those three questions, where's the cash coming from? How are we going to isolate it from risk? And what's the tax bill going to be if we're successful in this project? Those three questions are mission critical to any kind of property structuring.
100%. And I think that's something we try to do up front when we're looking at clients' options. We put down their options based on their ability to borrow in their personal name, their ability to borrow in a company or trust, and their ability to borrow in a self-managed super fund as well. So for us, we can then engage our other advisors and say, hey, from a taxation perspective, what's going to be best for us? And that may be best for us today, but what are we forgoing tomorrow? Because if we get the tax benefit today, which is going to be great, that's going to serve us in the short term, but we're forgoing these benefits, are we happy to proceed with that opportunity cost? And I think it's the same, from a legal perspective as well. What risks are we taking if we're buying in our personal name? What does our business affairs look like? Are we carrying more risk than, say, the average individual would, versus needing to buy in a company or a trust?
Yeah, and it also depends on how many partners are in a project. So, for example, if you're dealing with a huge number of partners, then you might be more inclined to use a unit trust. If you're dealing with just yourself or a very small limited number of people, you might use a company for various reasons. Now, obviously, the capital gains tax implications of using a trust versus a company are different, and we work closely with the accountants to sort of run those numbers and those hypothetical scenarios with the client. But we're seeing more and more for properties, commercial properties and residential properties, but predominantly commercial that are intended to be bought and held. We're seeing a lot more use of companies as opposed to trust structures.
Well, I think we were talking about this before, but I guess using bucket companies that then distribute to new SPVs for the investment versus, say, investing as an individual. Can you talk through the benefits of investing, via an SPV and sourcing that money from a bucket rather than from, say, a loan that you obtain individually and then contribute to the company, and the benefits you see there?
Yeah, absolutely. So, I don't want to confuse the audience in terms of things that they may not be aware of, but the general premise is that a lot of people that are engaged in property investing are making money from a trading business. And that trading business pays between 25 and 30 cents in the dollar in corporate income tax in Australia. And the other general rule of thumb is, in order for an individual to put that money in their hands, they pay another batch of tax, which is called top-up tax, of effectively 20%. So that's where, when people say that you get taxed 47 cents in the dollar in Australia, that's where that concept comes from. Now, what we're seeing more and more use of is what's called a bucket company, where profits are distributed out of the trading business. A family might be making their core living out of their trading business. They distribute that money not to an individual, where 47 cents in the dollar in tax is paid, but they distribute that income to another company, and there is no top-up tax. That additional 20% doesn't have to be paid. So, on $1 million dividend, for example, there's an extra 200 grand that can be lent or pushed into a property acquisition.
Which is significant, and that's per annum, depending on the income that business is generating.
Absolutely. And so we're particularly seeing, people that have, maybe they're 5-10 years into business, their business is spitting off good income, and they want to maximize the opportunity to go and buy, a number of properties that, are attractive to them. They'll say, well, okay, I'm going to cop the hit, knowing that the capital gains taxing implications of selling a property from a company are not as optimal as selling a property from a trust. But what it gives me is more cash up front, and I will basically back myself that the compound growth of the property outweighs the capital gains tax downside at the end.
And it's interesting, we see that a lot for business owners and investors as well, depending on where they're earning their money from, because by potentially using the cash that you generate as a deposit versus drawing that equity, you're keeping that within an income tax level of 25 to 30%, and we're diversifying that risk away from the business. So we see a lot of people, after building a residential portfolio and wanting to move to commercial to optimize their yield, or a lot of business owners that are earning substantial income from their business, but there's an element of risk there that they want to diversify. So
Absolutely.
By purchasing commercial property, they can look to buy high yielding assets that are earning between 5 to 8% net, and by putting that money into those SPVs and buying these commercial properties tax effectively, they're looking to diversify the income that they earn from the business into property, and ultimately that is their potential exit strategy if they do look to sell or scale down the business and still earn a level of income that they're comfortable with a lot more passive nature versus what the business is.
Yeah, that's really common, and in our mergers and acquisitions practice, it'll regularly, maybe 60-70% of the time be the case that the business is sold, perhaps to private equity or perhaps to another trade buyer, but the properties have actually been bought by the family or the owners over the years, and they continue to hold their own properties as landlord despite the fact that they've on-sold their trading business. So we see that as a pretty effective strategy for a lot of our clients as well. Can you afford, or can you gear up using debt and working with someone like yourself to effectively go and buy the premises that your business should occupy? And that's kind of a question depending on the state of growth in which the business is in, right? For example, for us to go and buy a commercial floor in an office building in the CBD of Sydney when we're growing at the rate we're growing is probably not a good use of capital. But for somebody who is a childcare centre operator and also would like to buy the bricks and mortar in which they're trading from, awesome strategy.
And that comes back to having the right lease in place, right? So if you're potentially renting a property, and we spoke about this before around ensuring that your lease has the right clauses, maybe it's the first right of refusal. But you mentioned another clause, which I didn't actually know about, that's really important for those individuals that may want to buy that business premises.
Yeah, so for sure, like if we can get a first right of refusal, amazing. But what we've seen a little bit of in recent times is a last right of refusal. Now, the optimal is both, first and last, because you get first look at the property that you're a tenant of and you can put in an offer. But more importantly, you can see, if it goes to market, what is the best offer the landlord's received, and are you willing or can you afford to match or better it? Now, we rarely see first and last rights of refusal where the landlord takes the property to public auction, because the general thought process or rule of thumb is that if a property is going to auction, then best buyer wins on the day. But certainly, we've seen that, and we do a lot of work in the childcare space, and so the first right of refusal stuff has been massive. That tenants, particularly the better quality tenants, are saying, well, yes, we will lease the premises, yes, we like your premises, but we need to be able to find a way to buy this when you ultimately dispose of the bricks and mortar.
It's really interesting because buying the place you operate out of is a conversation we have a lot with a lot of business owners. Because again, based on that yield, as long as it's based on a market yield, the value of that property is really derived from that rental income. So we find a lot of business owners, trying to buy where they're operating from, or if they're looking to relocate, looking to buy that property, own it within a unit trust or perhaps even a self-managed super fund, depending on what they're trying to achieve. But it's another tool in their belt from an exit strategy perspective that we see, with them potentially operating for the next 5 years and then signing on for a 10+10 option, assigning a value to that building, and then potentially selling the operating business by taking, I guess, that income off the table, but having that source of income from, I guess, the property that they own, and they're now leasing out on a 10x10 lease. Do you see any issues with people doing that via a unit trust versus self-managed super, or does it really depend on the exit horizon for that individual?
It really depends on the exit horizon. I mean, the compulsory nature of super in our country makes it kind of a no-brainer that people can look to acquire a property in which they occupy using their own superannuation, because from a risk perspective, you as a business owner should know if you can afford to pay the rent or not over an extended period of time. And even if you sell that business, you should know if your purchaser can afford to pay that rent over an extended period of time. So for me, it's not so much about SMSF versus unit trust versus corporate. I think, if you wanted to put some general rules around it, SMSF should be the first thing that's looked at. Is there cash sitting there? Does the person want to diversify their portfolio? Some people have a different view that they want to use their their super for exposure to equities on the ASX or overseas, whereas others are just hardcore property players and want to shove every single dollar they can scratch into property. And that, I think, by and large, that's been the Australian mentality for a long, long time.
It's interesting. It's that leverage versus no leverage conversation, right? You're going to get your return on your $1, or you're going to leverage that $1 into 10 and get your return on that principal. And I think that's what a lot of people, I guess, look to toss up. I was one of them, but I've taken a view that I'm going to be putting my money in super into a commercial property when the time is right. But yeah, it's interesting that a lot of people still have that thought as well.
Yeah, look, I've done a lot of mergers and acquisitions for over the last 10, 15 years, and I kind of have a really old school view that stuff listed on the ASX at 25 times earnings is questionable. Someone's been, if you're paying 25 times earnings or more, then you've probably been oversold, in my view. But that's my personal, probably overly conservative view. Private treaty businesses can sell anywhere between sort of 3 and 10 times earnings, and that kind of feels right. So I have a sort of a personal view that to go and dump a whole heap of cash into ASX listed stuff, perhaps it's not for me, but other people love it and have made a lot of money out of it. But I think that to touch back on that structuring point, obviously super is money that has to be put somewhere. Most people have a little nest egg or a little pool at least. Some people have a lot in super, so that should at least be a conversation that the finance broker and the accountant have, for sure. In terms of that unit trust versus company question, for me, it's really about the intended development of the project, and whether there's any development upside intended, in which case, perhaps a unit trust is more appropriate. And as I mentioned before, how many partners are involved and when is the exit horizon? Those kind of things taken together, the finance broker, lawyer, and accountant pretty quickly, within half an hour or an hour, could probably come up with a structure for any property investor.
Great advice. Yeah. On the mergers and acquisitions piece you touched on, we do a lot of business acquisitions for clients buying their first business, looking to vertically or horizontally integrate, and also look to buy multiple businesses as part of their strategy. In terms of finance, it's something that I think is assumed that all businesses are created equal when it comes to getting leverage. You mentioned private equity. It's something that we do a little bit of as well, and they're more specialized transactions, so they don't fit every single bank depending on the industry and what they're looking to play on. And I think it's worth mentioning for the audience that the bank's preference for any type of business acquisition is residential or commercial property.
For sure.
For them, that is the safest form of security because it's tangible. They can do an external valuation, they can apply a certain level of LVR, and they've got certainty around if we needed to exit this business, we would at least get X back based on the money that we lent out. But it's not the only source of funding for businesses. And as you go up the deal curve, and depending on the type of business you are, you can potentially access money on an unsecured basis, which is known as a balance sheet or a cash flow lend. Tell me, do you see a lot of clients utilizing that form of funding for the business acquisitions that you see?
Yeah, definitely. And I also think I've seen a bigger appetite generally from the banks in the last couple of years as interest rates have crept up, as competition for the residential market has crept up for the banks. We are seeing banks start to dip their toes back into cash flow lens, and depending on the sophistication or the credit rating that the banks have applied to a particular industry, we are seeing 80%, 70-80% LVR lens on a trading business, which means that for a purchaser of a business, they can get into a business that probably has good cash flow generation pretty effectively. Now, if that business is something that the person's worked in or they're familiar with the industry, it can be a no-brainer for them to use leverage in acquiring a business. In fact, we would see there's very few business purchases we see these days that don't have a significant element of leverage in them.
And again, we see the same thing. And my conversation with investors is, first and foremost, we want to conserve your cash because cash is king. Cash allows us to sleep at night. There's money, to put into investments opportunistically. And the debt that we're borrowing is more often than not tax deductible.
Yes.
So if we're using it to buy a business, it's going to be trading and earning money. We're going to be getting a return, from that money by way of a tax deduction. So we have the same approach where we want to look to use as much leverage as possible. Generally, we see the banks measuring that as a multiple of EBIT. So depending on where those businesses trade from a sale perspective, whether it's 3, 5, 7 times, the bank would look to come in at a multiple of EBIT and generally cap it at a percentage of the purchase. For most businesses that aren't at that institutional level, so we're talking sort of anywhere from 1 to 10, we're kind of seeing 3 to 5 times as the sales multiple, with the banks doing probably up to 50-60% of that level. But then we can also fill that shortfall by way of cash or equity, or potentially equity in your existing business if you're buying something else. Tell me, when it comes to private equity deals, where do you see the private equity firms starting to get interested in acquiring or investing in those trading businesses?
To be honest, there's private equity firms of all shapes and sizes. We've acted on the sale of a small wholesale bakery business last year. I think the purchase price was a couple of $1 million, and there are private equity firms that are happily running around bolting on 2, 3, 4, 5, $10 million businesses in what they call a bolt-on strategy, where they acquire a core asset and then they bolt a whole heap of stuff into it.
Is that like a vertical and a horizontal sort of integration strategy?
Any which way possible that sort of fits around the sphere of the core business they've bought. We definitely see that. But then in terms of, other than bolt-ons, your more substantial private equity firms, they're really going to want to see a core asset that probably is in excess of $50 million in value before they really sort of sink their teeth into it and bolt it into their portfolio. Having said that, there are private equity firms of all shapes and sizes, and really it's about when these clients take their businesses to market, it's about finding the right buyer at the right price. So it varies a lot. An interesting point you made was about unlocking value in your existing business. And so one conversation we've been having a lot of lately is, are there founders or owners of a business who are paying non-deductible interest on a home on a principal place of residence, when in fact that they could work with a finance broker like you to obtain an overdraft or a business facility that would be deductible, with a view to stripping any surplus retained earnings out to pay off home loans that are non-deductible.
Absolutely, and we've done that before around repaying directors' loans. So if they've contributed a significant amount of money into the business, we can potentially leverage against the business to repay that loan and potentially clear their home loan and zero a whole bunch of non-deductible debt out, which could have taken years and a lot of top-up tax payable to get that money out of the business and pay down that debt.
Yeah, I think that's right. I think, for a business owner, the worst strategy you could deploy would be no strategy at all, where all you do is basically collect your income from your trading business, and then in 30 years' time you look at it and you go, well, I haven't actually had my money work for me over the last 20 or 30 years. I've worked for my money, because once you retire, really, there needs to be a pool of assets from which income can be generated, and that effectively forms the legacy that they can hand on to their family members, assuming they've got families.
Nick, thank you for being here today. I'd love for you to leave us with your last piece of advice that you think property owners or investors should take away from today's session.
Yeah, I think, Matt, I think the main thing is for commercial property investors, right? Understand the lease you are buying. That's the key take home. Residential stuff, your conveyancer or your lawyer can pretty much get their hands around very quickly. But for commercial property investors, understand the lease you're buying. That's the number one piece of advice I have for property investors. But it's been an absolute pleasure as always, and I thank you for having me on.